Welcome to Retirement Unlocked with Larry Heller. Your life, your way, unlimited possibilities. Join us as we explore how tailored financial planning and investments can help you navigate life transitions with confidence. Let's dive into this week's episode.
And welcome back to Retirement Unlocked with your host, Larry Heller. Joining us today is Scott Bosworth, CFA, head of the Speakers Bureau and vice president at Dimensional Fund Advisors, headquartered in Austin, Texas. Scott has been with Dimensional since 1996 and brings decades of experience as a portfolio manager, institutional and advisory consultant, and leader of the firm's most complex advisory relationships. In this episode, we dive into the psychology of investing. We explore the behavioral biases that investors should be most aware of. Scott also shares some practical framework and stories that help explain why understanding investor behavior is so critical to long-term success. If you've ever wondered why investing feels harder than it should, or how decisions can come from understanding how we think, this is a podcast you do not want to miss. And with that, hello, Larry.
Hi, Bill. How are you?
I'm great, thanks. I'm great. I'm looking forward to this conversation. Now, I always like hearing about the psychology, about the behavioral biases that we as investors bring to the entire process that we most of the time are not aware of.
Well, we got the expert right here to talk about that.
Excellent.
So, Scott, thanks for joining us today. I'm really looking forward to this. And you mentioned 1996. I think we know each other almost as long as that without giving away.
It's been a while.
It's been a while. So why don't we kick it off? Because I think our listeners are going to love this topic. And for those who are not familiar, why don't we just start right at the beginning and kind of what is behavioral finance and why should someone be interested in this?
Yeah, so behavioral finance is a field of study that was sort of born out of behavioral economics, which really was born out itself from just this idea of how people make decisions when faced with uncertainty. It really goes back to the official academic research into it goes back to the 60s and 70s. Gentlemen by the name of Daniel Kahneman and Amos Tversky were sort of the pioneers in the field, but it really had to do with all these mental shortcuts we make to sort of simplify our lives and simplify decision-making and sort of like just being human. What they began to uncover were how these shortcuts, while they're very useful in regular everyday life and in lots of aspects of being a human in a society, they lead to what they called sometimes severe and systematic errors in decision-making when faced with, areas of uncertainty. And of course, being an investor, we're in a stock market or a bond market globally, that's kind of the definition of an uncertain environment, which is why sort of the birth of behavioral economics, the birth of behavioral finance, to really start to dig into this stuff as it relates to investing specifically.
Right. And I guess this even comes more into play when we kind of have years that the market is way up, and especially those years that the market is way down, which we'll talk about. But how long have you been studying investor behavior, and what got you interested in this originally?
Well, I've been with the firm for almost 30 years and, very academic based firm, but mostly sort of on the evidence of how markets work. So around the global financial crisis, probably a few years before that, because, as you remember, Larry, just a few years before the global financial crisis in 2008, we had the sort of the tech bubble and burst of 2000, 2001, and 2002. So coming out of that, I started reading a little bit in it. It was very much a minor hobby of mine. But in 2008, I had an advisor approach me. Actually, it was in early 2009. And if you remember, 2009 ended up being a great year in the markets, but we didn't know that in the first few weeks. And an advisor approached me and said, Scott, I know the right answer. I know what to tell my clients, but this whole just be patient and wait it out and stay in your seat is getting a little bit long in the tooth. Do you have anything else that maybe appeals more to the emotional side of investing? And at that point in time, we really didn't have that much. So I, took it upon myself to create a presentation I read some books. There was a great one that came out actually in 2008 by a columnist at the Wall Street Journal named Jason Zweig, and it was called Your Money and Your Brains. That was the first book I read on the subject. I found it fascinating. Kind of off I went, and so for the last 15 plus years, I've been doing presentations and other sorts of events talking about investor psychology.
So I know there are a lot of different biases that are out there from all this work and all this study, but what are the main biases that investors should be most aware of?
Yeah, it's a great question, because if you start digging into this without any guidance, there's a Wikipedia page that lists cognitive biases. You could look it up. There's 245. Don't bother counting them. I did it for you. Now it's a number that changes because this is a very well studied area of behavior of finance now. It didn't used to be. So new academics are coming up with new and clever ways of describing, really nuanced biases that show up in certain environments. They have clever names for them, like the turkey illusion or the G.I. Joe fallacy. But you can get a little bit into the weeds with this stuff, and I like to try to take a step back and say, okay, what's happening? Why do we think the way we do? Why do we use intuition or instinct sometimes improperly? And it's just how we're wired. So I would first caution people to avoid buying into the fact that this is irrational. That Jason Zweig book I talked about, he has a quote. I'm going to paraphrase it, but he, and I think it stuck with me back in 2009, and I've sort of like carried it forward all these years. But he said, our brains have a way of making investment decisions that are without any logic, but they make a lot of sense emotionally. He says, and this is the key sentence, that doesn't make us irrational, it makes us human. And I leaned into that sort of concept that this isn't irrational. In other words, if you could cure yourself of these biases by taking a pill or taking a class, you probably wouldn't want to, because while it might make you a much more solid investor and you'd be able to completely ignore all the emotional side of things, it might make you a very difficult human being to be around. I think I think Buffett said, a really good investor has to have some element of social anxiety or sort of introversion. So, but the good news, I shouldn't say the good news, but the truth is you cannot cure yourself of what these biases are doing, because it's how we're wired, and we're wired that way for really good reasons. It goes back to survival instinct. And it goes back to what the academics call these psychological defenses. So what are those? Those are defenses that, when we make a mistake, we don't beat ourselves up too much, because we have psychological defenses that sort of make us feel better about the mistakes we make. They make us feel better about the situations we're in that we can't control. It's not necessarily helpful in a logical way, but it's very helpful in an emotional way to keep us from, sort of like getting into despair.
So if you know that there are these biases out there and you know that you have some of them, how do you kind of, work on that so you don't make an irrational decision at an inopportune time?
Well, awareness is the first step, right? So just being aware that these exist. But it's been well documented. It's actually the one I mentioned earlier, the G.I. Joe fallacy, is actually a named bias that essentially is about biases. It's saying knowing these things is not half the battle. It's a very small part of the battle. And the problem, what's come up in research over the years, is that it's really easy to see this sort of in an abstract way. It's really easy to see this in other people, but it's very difficult in the moment to know that you're making a decision that has suboptimal expectation, because at the moment it feels good emotionally. Maybe the classic example would be someone who's hearing nothing but bad news in the economy and in politics, and has convinced themselves that the market is going to crash imminently. And so that emotional decision might be to, take a lot of risk off the table, to change their portfolio in the face of that anxiety. We know from academic research, it's very unlikely you're going to get that trade right. You've seen it, Larry. I've seen it for 30 years. It's all over the place. I would even argue the worst thing that can happen to an investor is they do get it right the first time, because then that feeds what is probably the #1 bias in all of academic literature, and that's the overconfidence bias, right? We all think we're a little bit, well, I shouldn't say we all. I mean, any blanket statement like that is bound to be wrong, but on average, people tend to be overconfident. You may think, well, no, I'm not like that, but I know my brother-in-law sure is. Like, there's always that ability to see it in other people. And an inability to see it in yourselves. There's nothing wrong with being overconfident. Overconfidence drives a lot of innovation. It allows us to take risks. It allows us to sort of advance society. There's a lot of good reasons. Also, overconfidence, having a little bit more confidence than is deserved does make you feel better, right? You sort of have the ability to try a little bit harder, and you can see the emotional benefit of it. But there's a great quote from years ago, a guy named Charlie Munger, who many of you may know. He was Warren Buffett's right-hand man. He passed away recently, sadly, but had a great life.
He loved to
say, what's that?
I think he was 95. And he
was. So we should all be so lucky, right?
Yep.
Also, did very well at Berkshire Hathaway, of course, but he used to say about overconfidence, he said, it's the strong swimmers who drown. Now that's a cute quote, maybe not cute, but maybe sort of a dark quote. But his point is, if you think you're really good at something, you're liable to take more risk and present more opportunities, if you will, for catastrophe. So when you think about investing, if you think you know how to time markets or how to time your participation in individual securities, you're probably going to take more risk that may pay off, but the probabilities are not in your favor, right? The odds are those types of concentrated or timing bets are more likely going to cost you more money than they're going to save you or make you. So that's just one example of how overconfidence, the awareness to remind yourself that, hey, I'm not going to try to cure myself of my confidence, but I'm going to make sure I know when it might be picking up.
Yeah.
Now, easier said than done.
Yeah. I mean, some of those kind of behavioral, irrational ones, we've had a few relatively new clients in the beginning of the year. They were like, I listened to so-and-so and who thinks there's going to be a major correction. Can we just reduce our equity exposure by get out, and I'll just wait until that happens, and then I'll get back in. So usually the clients have been with us for a long time, have seen the ups and downs, and so they've kind of got that out of their head, and I can deal with some of those kind of mental type of behaviors. But you still, even after all these years, I'm still hearing that. So I don't know your thoughts on that, and maybe there's a bias from the media out there.
Well, I would argue there probably is a media bias. I think alarming headlines and articles are certainly more click-worthy than articles that say, actually, it doesn't really matter what the news is. Just relax and go work on your handicap or your tan or learn how to play pickleball, right? I mean, I think most people are not able to take that advice because the media does not reinforce a patient long-term approach. But it's not the media's fault, because the media is being asked to do something, which is they are being asked to provide news on a daily basis, which is tough to do. They also know they're going to follow the readership. They're going to follow the clicks, if you will. And, those sensational articles probably get more attention than the more sort of, subdued articles that tell you tune out all this stuff because it doesn't matter. This brings up something for me about this idea. We often refer to this thing called the market all the time. It's almost like it's got its own consciousness, or it's being controlled like a Wizard of Oz puppet master. But I think it's important for everybody to remember the market is never right or wrong. The market is a weighing machine of everybody, all of us collectively, with our different opinions, our different levels of knowledge, our different emotions. All of that stuff is weighing the price of everything all the time. So if it's traded on a public exchange like a stock or a bond, Those things, that's the right price because that's the price today that people are willing to transact at. There's no sort of secret star society in some boardroom somewhere that's setting these prices and it's rigged or gamed. So when someone says, you know, I'm nervous, I hear nothing but bad news, I think the market is overpriced, what they're really saying is, I'm disagreeing with the collective wisdom and experience and emotions of everybody else. And they might end up being right, but they might end up being right later, right? It's like, you know, you have these people in the media who are constantly bearish, right? They're like, everything's always, the sky's always falling. And, you know, it might be falling for years before it actually falls. So this idea of trying to time that is really a fool's game. What you want to do is have the right level of risk in your portfolio that you can afford to, you know, I like to say it's not about avoiding the storms on the journey. It's about surviving the storms on the journey. You know, if you try to avoid them, you're going to end up detouring and it's going to take you a lot longer to reach your goals. If you just have the right vehicle or portfolio to survive those storms, it's robust enough, you've got diversification, you're controlling things like costs and taxes, and you've got a really good captain and crew, and that's where the advisor comes in. It's really hard to do this by yourself. A few people can do it, but the evidence suggests that most people benefit greatly from having an objective third-party professional managing all of the elements of wealth management. I mean, investment portfolios is just one small part of the things that you all do.
Yeah. No, I love that theory, riding out the storm. And really, you know, kind of what we're doing is trying to have them prepared. I mean, for our retired clients that have distributions and having enough cash to ride out the storm over a couple year period in case we have one of those 2008s. But, you know, having those communications on those conversations help alleviate some of those behaviors when we do have a downturn. And speaking about, the market, the theories of an efficient market and behavioral finance seem to be at odds. We've talked about kind of different ways of thinking about those two. Can you explain a little bit more about that?
Yeah, well, I happen to be in a good seat. I mean, I'm close to one half of that debate, which is Gene Fama. He's considered largely to be the sort of the father of the efficient markets camp, if you will. And that's this camp that says, look, markets are really tough to beat because they incorporate all this information so quickly and they adjust to new information very quickly. So very difficult to outguess. Along comes behavioral finance, maybe a couple of decades later, that has gained a lot of traction. And I think originally behavioral finance was viewed as sort of an update to how to approach investing in the markets. It said the efficient market theory clearly isn't right because we've learned all this stuff about how irrational investors' decisions are. And I take a different approach to that. I still think efficient markets is the only model that works really well to help us build portfolios around costs, diversification, flexibility, expected returns, all that stuff we've learned from kind of the empirical evidence. And what behavioral finance does is it tells us how to behave with that portfolio. So they really are both critical. And the analogy I like to give is, I use the analogy of a ship that weathers the storm. Well, to kind of continue with that journey metaphor, I'm talking about building a car for a journey, that journey being your investment lifetime, your investment journey. You want to have the right car. And I think efficient markets helps us build the right car for each individual investor. What behavioral finance does is it tells us how to drive the car. Because you got to have both right. If you have the wrong vehicle, that's not going to work. If you have the right vehicle, but you keep taking detours or running out of gas or getting flat tires, that's not going to work either. And I think when you come to the realization that both of these things are super important and one does not cancel the other out. And look, Gene Fama and Richard Thaler, they're both at the University of Chicago. They're actually colleagues. They get along well. I think back in the day, they used to play tennis together. They're the competing sort of Nobel Prize winners of their respective fields. And even they, at the end of the debates that they might have on it, kind of agree that, behavioral finance doesn't really tell you much about how to build a better portfolio. What it does tell you is how to manage your investment journey. And I think that's a really important insight for people to take away.
Yeah, and not only managing the journey, it's really the communication, and just really having those communications. I think we had one client, we were talking about this and talking about the ups and downs. And it's one of these years we're going to get together, do your review, and you're going to be down. I think it was like 5 straight years he was up. So, but trying to have those communications together. So when you go through these time frames, I mean, I just remember 2008 having some of the calls during the toughest time frame with people going through pain and significant losses, and people would I just want to stop the bleeding. So really, if you can really start to educate them about the markets and about how it works and staying the journey, that's kind of what, we're there for, to hold their hand in those particular times and not make an irrational decision. So, planning ahead and knowing about this thing, I think, is so critical. Scott, are there some other particular stories or frameworks you find useful in trying to explain this area of study?
Yeah, we've kind of danced around them. Thanks for asking. I mentioned specifically, overconfidence is this, sort of underlying bias that drives a lot of this other stuff. But there's, if you do go to that Wikipedia page and start, combing through the close to 250 biases, I would say there's a few that for me are particularly relevant and salient for investors. And it's, there's the illusion of control, there's loss aversion, there's hindsight bias. I'll stop on hindsight bias for a second, because this is an interesting one. And I think what it basically, and it unpacks a lot of other sort of tangents, but there's an old saying about hindsight. Larry, I'm gonna quiz you. What's the old saying about hindsight? The old quip. Hindsight is
2020. I'm not sure.
Hindsight is 2020.
Okay.
We didn't prep that, so I appreciate you playing along. Hindsight's 2020. Now, why do we say that? Because we have perfect clarity about what happened. Mm-hmm. Here's what our brains do, and this is really fascinating. And this has been studied quite a bit by Kahneman and Tversky and dozens of other academics, is that when we look back at an event like the global financial crisis or like the .com or even things outside of the investment realm, we often, what our brains do is they look at that and they go, oh, I should have seen that coming. It seems so obvious now. And that's damaging and sort of insidious, because what it does to our brains is it makes us think the next thing should be more predictable than it actually is. So we then spend all this energy, emotional and monetary and just time, trying to predict that next thing that we should have seen coming. And the psychologists find this fascinating. So it results in a lot of things. Hindsight bias is this bias that because the past seemed obvious, the future is more predictable than it is. And it ends up, I read this book a few years back by a former poker player named Annie Duke. And Annie now consults to Fortune 500 companies. She's like a strategic consultant for boardrooms. But she wrote about hindsight bias in her book, Thinking in Bets. I was going to say Thinking Fast and Slow, which is Kahneman's book. But her book, Thinking in Bets, talked about hindsight bias. And she introduced a concept to me from psychology that I was not aware of before. And it was called resulting. And what resulting is, it's something I see a lot, Larry, I'm sure you do too, in your clients and the industry. Resulting is this idea of, because I got a bad outcome, I'm now questioning the decision I made that led to that outcome. Mm-hmm. And so now going forward, I'm going to make a different decision because I didn't like the outcome. So an example would be, maybe in the last few years, the U.S. stock market has outperformed most other global stock markets, depending on what start and end date you want to use. That wasn't true in 2025, but that has been true for most of the past, say, 8 to 10 years. Mm-hmm. So someone might say or think, I live in the U.S., I consume in the U.S. Why do I have all these global stocks? Shouldn't I just be investing in the U.S.? Because I would have had a much better return had I just focused my investments in the U.S. That is, to a T, this bias of resulting. you made the right decision by being globally diversified. We didn't know what the outcome was going to be over that period of time, and we don't know what the outcome is going to be going forward. I'm not suggesting that people say, oh, now you're saying the U.S. is overvalued and I should pare it back. No. I'm not saying that at all. I'm saying the diversified, plan worked then and works now for what we don't know is going to happen going forward. And that's, look, we don't know where lightning's going to strike. And I like to remind people, even if you stay globally diversified, which I believe is the right answer, and the U.S. continues to outperform other markets over a long period of time, that's actually not going to be a bad result for you, right? The global diversification is still a good idea, even if this U.S. dominance continues. Now, 2025, we saw non-U.S. markets, I think, outperform U.S. markets, depending on how you measure it, by roughly a factor of 2 to 1. So that was nice to see. But that doesn't change anything. It doesn't prove anybody right or wrong. It just says, hey, global diversification is there for a reason. Let's not question that decision because we got a bad luck of the draw, if you will.
Yeah. I've been talking to my son, talked to some other young people who are saying, why don't I just put everything in the S&P 500, the U.S. market? And they said, well, that's what Warren Buffett said. If you're young, just kind of do this. And they're looking at those numbers. Yeah. This year, 2025 international had a nice year. But, the last few years, people are like, why do I have to be in that? So it's hard to kind of look at the evidence-based, the long-term efficient markets and be diversified like we do and explain those type of situations, because it is really a bias. But then I try to talk to them about the lost decade, 1990 to 2000, where the S&P 500 was just down a smidgen. And they're like looking at you because they didn't live through that. It's like, really? Can that really happen? So, so it is some interesting conversations to have.
No, I agree. Look, I mean, I think the lost decade was 2000 to 2009. And I remember it really well. It was bookended by you had the dot-com in the beginning. You had the global financial crisis near the end. I think a globally diversified portfolio did much better than a U.S.-based portfolio for that 10-year period. So that's to your point. But, I look at it like this. Some country or some region has to be the best performer. I mean, that's just how markets work, right? When you rank them all after some period of time, there's going to be a number one country and there's going to be a last country. And I don't know what that's going to be going forward. So, the fact that over the last X number of years, the U.S. was either number one or close to the top, that doesn't mean that's going to repeat, but it also doesn't mean that that was something I should have seen coming and should have done something about. As a U.S. investor, I benefited from that way more than I would have had I been a European investor or an Australian investor or an investor in Japan, right? Because they're probably going to have a lot more of their assets in their home country. And their home country turned out to not be the country that outperformed all the others. So, there's a perspective issue that I think we often lose sight of. I'm a huge fan of diversification. I think it was, Merton Miller or somebody before him that said, diversification is the only free lunch in investing. You should eat as much of it as you can. Because it's really, now maybe back in the 60s and 70s, it wasn't that easy to be globally diversified. Today, you've got no excuse. It's really inexpensive to have a globally diversified portfolio that covers all the countries, tens of thousands of securities, stocks and bonds, and get the right balance that you can stick with. Get the vehicle that's going to survive that journey, survive those storms that are inevitably going to come, and you don't have to make any decisions. Well, let me rephrase that. You do have to make a decision routinely, and that is to not change anything. Some people think of that as inaction or, sort of like un-American or something, but really you're making a very, a decision of fortitude, of great fortitude to stay the course in the face of really good markets when you might have some little FOMO creeping in, like gold or cryptocurrency or Nvidia, or you might have periods where it's anxiety because the market is going down. Rebalance, keep that ship robust, and keep that long-term perspective. Again, it's easy to say, it's harder to do. And Larry, I like to remind people, just because I've been a dimensional for 30 years, just because I've been studying this my whole career, doesn't mean I don't have those hunches too. those emotions come up. I read the same articles that all your clients are reading and all my clients are reading, and I get those hunches. But heaven forbid we would invest anybody's life savings based on my emotions and hunches.
Right. Scott, this has been great. I can talk about this topic. It's fascinating for a long time. Thank you for joining us today. I appreciate all the time and everything that you do at Dimensional. So hopefully listeners out there got a little bit of a benefit and help on kind of all these biases and irrational behavior and how to maybe minimize some of their emotional decisions. So thanks again, Scott.
Yeah, Larry, thanks for having me on. Great to see you, and I appreciate it.
And before I close this out, Larry, I just have to jump in here. As a former financial news reporter, I spent several decades covering business and financial news markets. I want to go back to something you said, Scott. Actually, business and financial news is not tasked with delivering information. Business and financial news is tasked with delivering eyeballs. They want viewers. Information is incidental to that. So what information is going to drive it the most? The headline of the house is on fire or the house is okay.
That's pretty well put.
But thanks. That was a fascinating conversation and really, really interesting. Thank you very much. I appreciate it.
Thanks, Bill.
And as always, Larry, another excellent podcast. Thank you so much.
Great. My pleasure.
And listeners, thank you for joining us on Retirement Unlocked. If this episode has helped you better understand how investor behavior and biases influence financial decisions, be sure to like, subscribe, and share it with someone who wants to be a little smarter and maybe a little more confident in their investment choices. Want to make your investment strategy, make sure it's aligned not just with the markets, but how you actually think and behave as an investor? Check the episode description for a link to Heller Wealth Management, where you will find additional resources and the option to schedule a complimentary 20-minute call with our team. Better investing starts with better decisions, and those decisions start with understanding behavior. Thanks for joining us. We'll see you next time.